Hi everyone, it's Jack about another video. Today I'm going to be talking about Intel, which just released its Q4 earnings report and its full year results. The last couple of earnings reports for this business have been a disaster for the stock. It's been down 37% in the last year, much worse over the longer term. This is a business that is looking like it's in decline. There is of course a potential comeback story here. There's a lot of long-term tailwinds for businesses like Intel. With the CHIPS Act in America, there's a lot of funding going to become available for this company and a lot of need for onshoring of semiconductor manufacturing. It's still a very large business and a big mover and shaker in the semiconductor industry. However, it looks like it's declining. So let's jump into these earnings reports and see if there's any value to be had in this business and if the stock is possibly a buy right now. The Q4 results are pretty rough. $14 billion in revenue, that's down 28% year over year, which is of course within their October outlook range, so we shouldn't be overly surprised by this. It is at the lower end of this outlook, but this is not good. A company that's declined in revenue 28% year over year, that is poor. 43.8% gross margin is one of the lowest we've seen for this company in a very long time, down 12 percentage points year over year. 1.2 percentage points below their October outlook, so it's actually worsening the situation. And earnings per share was where this was shown most significantly, down 92% year over year to just 10 cents of earnings per share for the quarter, and that is 50% below the October outlook where they were believing they would see 20 cents. That is absolutely terrible. Your outlook in October and you missed it by 50%. That is staggering, a really bad miss in my opinion, and I'm just starting to lose faith in the management of this business, that they know what they're doing, or that shareholders can rely on them. If you miss your earnings by 50% from that outlook that you gave in October for Q4 results, that is awful. The full year numbers make for better reading. However, the majority of the declines have been in the last two quarters, so while these don't really give the scale of the deceleration, it's certainly worrying if the next two quarters are anything like the last two. Revenue $63 billion, down 16% year over year within their October outlook. 47.3% gross margin, the lowest they've had in a long time, down 10.8 percentage points year over year. That's basically within their October outlook. And earnings per share of $1.84. Bear in mind, the most recent quarter, it was just 10 cents. That is really concerning, the level of deceleration they're having here. Down 65% year over year and 11 cents below the outlook. So again, missed the outlook quite considerably, but that's basically the miss from this quarter. Looking at the business segments a bit more in depth, the client computing group, which is Intel's largest segment, this is the one that you would perhaps expect to be the lagger because the PC market is softening. Demand is not what it was last year, and that has been seen across many businesses, across Microsoft, AMD. It will be said that their revenue has not been hit anywhere near as hard as Intel's, down 36% year over year. It's now just $6.6 billion, and their operating income is positively dreadful, down 82%, and the margin it's lost 26 percentage points, down from 37% to just an 11% operating margin. This is the difference between a fantastic operating business and a pretty poor one in my opinion in this industry. That is really tough. Lower revenue, increased Intel 7 mix and higher inventory reserves mean they're just having to sell at lower costs. This is really poor, but again, kind of what we expect. They are underperforming their industry peers, but this is kind of what we expect. The big concern for me is the data center and AI group. Revenue for this business segment was down 33%, almost the same as the client computing group, which you would kind of expect to be down because the PC market softening. This sort of decline has just not been seen in its peers so far, and this is certainly worrying. Operating income down 84%. The margin has shrunk from 37% to just 9%. This is a barely profitable business unit at the minute with just $400 million of profit on $4.3 billion of sales. They blamed their operating income losses on lower revenue, investment in the roadmap, blah, 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 and ramping the next generation products. I can kind of see that the lower revenue, they've lost some economies of scale. The bigger concern is why the revenue is lower. Lower revenue on total addressable market contraction and competitive pressure. Now, to me, competitive pressure is a diplomatic way of saying that other competitors have better products that have been chosen by certain clients have chose other competitors. This is definitely a competitive space, and Intel, in my opinion, are firmly losing this to Nvidia and AMD, and this has been a trend that we've seen for quite a long time, and it is definitely a worrying one for this business in the long term. Where it really starts to get scary for this business is the Q1 2023 outlook. Revenue going to be down 40% year over year to 10.5 to 11.5 billion. So you stretch that across the full year and we're looking at 40 to 45 billion in sales. That is pretty terrifying considering this year they registered 63 billion. 39% gross margin. So comparing that to the quarter-over-quarter basis, that's a 4.8% decline versus the last year's full year numbers. That's a further 8% decline, down 14 percentage points year over year. And earnings per share is going to flip to a loss, they're thinking, of 15 cents per share, down 117% year over year. This is a business that needs a lot of capex coming up. They've got multi-billion-dollar fabs being produced, and while they will get some money from the CHIPS Act, and there is a need for the US to deglobalize basically and onshore semiconductor manufacturing, I don't think Intel will be first choice if it's making terrible losses. They will have to put some money in their own, and these losses are going to extend over the medium term, in my opinion. I don't think this will be a tremendously profitable business in the short to medium term, meaning that the PE is going to go up, and it's not going to be such an attractive business to own for shareholders, and I can definitely see some pain in the future. I can see the dividend getting cut, and for me, this is a real no-go looking at this outlook. Stock is down around 7% after hours. From $30, let's call that $28. You divide that by the earnings per share of $1.84 on a trailing basis, that's a P ratio of 15.2. Intel has only traded a P ratio above 15 a couple of times in the last 13 years, and that was right now in 2018 and in 2010. That is an above average price to pay for this business, and it's on a trailing basis. On a forward basis, the P for this business is going to be extremely high because they're expecting losses going forward, and it could essentially, it's going to be infinite if they continue to make losses throughout the year. That means I can only see this stock price going down in the near future. This business is worsening, is spiralling for sure. I'm not sure they're going to be able to afford the capex is going forward unless they're very, very careful with the capital allocation, which I'm not sure this management is completely capable of so far from what I've seen. I just don't have the faith to put in them. I think the dividend, which is nearly 5% at the minute, is going to get cancelled sooner rather than later. There's going to be no share buybacks likely. I can only see this stock price going in one direction right now, and that is down. As I said, the stock is down 7% after hours. It's around high $27, $28. I expect that to go down a bit further. These are really not very good results, and the Q1 outlook is pretty poor in my opinion. I can see it pushing its 52-week low in the near future. Again, I can see that dividend getting cancelled, meaning income investors are going to probably want to get rid of this business. That P ratio is nowhere near 9 at the minute, and it's been much, much higher. I can see this being a less than $100 billion company pretty quickly, and I see a lot of pain on the horizon, at least in the short term for Intel shareholders. In the long term, perhaps this business can turn it around. I still kind of believe there's a comeback story here, in that the business has a lot of tailwinds going for it if it can right-size its ship. We are in a low point of the cycle for this business. However, I just think there's too many question marks around this business, and I could not possibly say that it's a buy right now. I think it's getting towards sell territory for even the strongest of Intel bulls right now, because these results are just getting worse and worse and worse. Again, that's just my opinion. You let me know in the comments down below what you think. Like and subscribe if you enjoyed the video. And remember, I'm not a financial advisor, so this is not financial advice. You should not take it as such. Do your own research and due diligence and form your opinions on Intel, and let me know about them in the comments below. I'll see you again next time.